All right, good Thursday afternoon. Finom Group members, traders, investors, our general YouTube audience. My name is Seth Golden, and if it's Thursday, it's Finom Group's weekly state of the market. And if it's Thursday, well, call me surprised. We've got a bid here, folks, and a pretty strong bid. If we can manage to hold this bid through the next hour and a half of intraday trading, this will be 4 days up in a row, at least for the Nasdaq, which has been leading this latest rally here into July. I think we started this rally Friday of last week, which somewhat anticipated based on some of the seasonal data that we looked at, if you recall, in our most recent research report and State of the Market. So headlining here, you see the graphic, folk, recession fears. As I mentioned last week, more than likely we are going to print 2 consecutive quarters of negative GDP, and a lot of it is predicated upon business inventories, wholesale inventories, and just the trade deficit. It's not in consumer spending, it's not in business investment, but the trade deficit is a significant component within the GDP, and it's weighing down inventories. Another significant component that is weighing down on GDP. It's really hard to listen to all of the fear mongering that takes place daily and weekly, whether it's financial media or social media, when everybody knows that this is not going to be a true recession, and still the likelihood of this being labeled a recession is very low. The National Bureau of Economic Research, which labels recession, looks at what's called the coincident economic indicators. And those are comprised of industrial production, real business sales, employment, and real income. None of those are in recessionary territory right now. In fact, the CEI, the coincidence economic indicator, it recently just hit a new high in the month of May. Go figure, right? We'll get the latest update here in July for the month of June, but there's a lag time between the leading economic indicators and the coincident economic indicators that the NBER uses to label a recession, and that lag is about 12 months. So nonetheless, now we're getting this commentary suggesting, well, it could be a technical recession. Yeah, okay, fine, great. Why are we afraid of a technical recession? And what's the difference between a technical recession and a mild recession? Now we're just going down a rabbit hole, aren't we? Nonetheless, the fearmongers, the pundits, they're going to do what they're going to do. It's up to you to stay above the fray, as they say. I'm a poet and I didn't even know it. All right, so recession fears. I love this. Jonathan Harrier, a friend of mine, and you can check him out on Twitter. The link is embedded here in his name. He had tweeted this out just the other day. Fear dominates in times that are especially uncomfortable. Who's not uncomfortable right now as an investor, right? Bear market, recession, yield curve inversion, whatever. Negative focus thinking is a self-perpetuating prison of the mind. The trader has control over their situation. The successful ones actually use it. Right? You determine if you want to live in this state of fear, if you want to think optimistically or pessimistically, if you want to look at historic precedents and know how this eventually will resolve favorably for the markets, favorably for the investors, or you can become, as Jonathan says, prisoner of the moment and a prisoner, in your mind. Let the fear dominate in these uncomfortable times. I tell you what, I don't know a single successful investor that lets their fears dominate their trading and their overall investment process. So it's up to you. Like, you can control this. And the successful investors and traders actually do. And if you find yourself, falling prey to the fear, it's impacting your game plan. It's impacting your ability to execute trades and your investments. Let me know. What am I here for? I certainly don't get paid to look pretty. I'm, probably not going to be making much off of that, right? Anyways, so as I said just before, we're kind of anticipating some strength in the market predicated upon the seasonal tendencies. Last week is when we kick off, one of the best 5, 6, 7-day stretches for S&P 500 returns in the year. The final 3 trading days of the Q2 period, the end of June, and the first few trading days or the first week of July typically have above average returns, when compared to any other day or week of the year. And that is what's happening. We got a 4-day rally going on, started last Friday, end of the quarter, seeped into the early parts of July. We'll see if this rally can have any legs, or if it's just another, bear market rally. There are signs, there are technicals, there's breadth that we look at to determine whether or not this is another, false attempt at resuming the uptrend, or if this could be the real thing. In earnest, what I would say is, no matter what we look at in the way of breadth and technicals, relative performance ratios, the macro fundamentals are so powerful right now, and they have been since the start of this year, given the inflation, given the Fed's battle against inflation and what they have to do and how that directly impacts the economy, directly impacts earnings. You see where I'm going with this. Macro fundamentals rule all. We can look at, technicals, breadth studies till we're blue in the face. But what we need to see is an improvement and a more sustainable, tailwinds in the macro fundamentals. That's what we need. That is what we need. All right, so we have been looking at, the worst, the Q2 period was down a little more than 15%. I think we were down 16% in the Q2 period of 2022. And we had looked at that, from this study here, Bespoke Investment Group. And, when you have a quarterly drop of 15% or greater, which is very rare, going back to 1946, keep that in mind. Our former study that we looked at last week just goes back to 1946. But it shows the next quarter, more than likely, you're going to have a gain. The only time we didn't, 2008. The next half of the year, again, more than likely, a gain, more substantial. And again, this is why there are several strategists out there counting on forecasting a back end of the year rally. They know their history. We've pulled forward a great amount of derating, deleveraging, forecasting by way of the S&P 500 price action this year. The market is telling you we're pricing in X amount of rate hikes, and we know that earnings are probably not going to grow 10% this year. So we're going to derate ahead of the earnings revisions to the downside. So what happens after that? You set the low bar, you reset expectations, and this is usually what happens. But this study only goes back to 1946, right? This is all post-World War II. Let's see what happens with Ned Davis research, which goes all the way back to 1929. 1929 there, folks. And so we have many more studies. We have many more occurrences of down 15% or greater quarters, right? All the cases, the percent positive, that's what we're most concerned with. Percent positivity rate for the next quarter, now it's only 61%, 68%, sorry. I mean, that's not bad, right? We have better than a 50-50 shot at having a positive quarter in the Q3 period. 2 quarters out, it gets better. Now, the returns are all great, right? But percent positivity in this environment, that's what we focus on. That's what we focus on. So again, going back to 1929, more occurrences, the probability that the next quarter is positive gets reduced. It looks a lot different than here. This would be in the high, almost 90%. This is 68%. And so they have, just post World War II, then that looks just like our study here. It's an 87 and a half, almost 90%. 100% of the time the next 2 quarters. That's the only difference in these 2 studies. One goes further back. But this gives you an example of why it's so important to look at the positivity percent as opposed to the average return. All right, moving ahead. The worst S&P 500 quarterly returns 1926 to 2022. And, this just gives you the more long-term time horizon, 1 year later, 3 years later, 5 years later, 10 years later. Like the only times that you ever saw 1 year later, 3, 5, and 10 years later, the market still not delivering a positive return was because of the Great Depression. 1929, it carried forward. They called it the Great Depression. It was what it was, folks. That's really the only time. 1939, that was another occasion. Longer term time horizons we're looking at here. All right, don't forget this study also, right? Because, this year it's been rough when it comes to historical data living up to, the hype and the discipline of quantitative analysis. But this one's working so far, folks. Recall that the S&P 500 had a 5-day decline of just over 10%. And that was June 6th through the 14th. The S&P 500 closed on June 14th at 3735. The next week it was higher, 1 week later. So the only thing that remains to be seen is whether or not we are above 3735 1 month later, because as you can see, 72% of the time, the market is higher. Average return or median return is 5.9%. The 1 week positive percent was almost a given, and we were higher a week later, 90% positivity rate. So this one is still in play. But it also tells you, 5-day decline of 10%. Folks, we have pulled forward a lot. This market has priced a lot of damage in the economy and earnings and, with respect to the equity risk premium and 60-40 balanced portfolios, equities versus bonds. The PE multiple has come down from 21 to less than 16 here this year, folks. We're trading below the 10-year and the 5-year average forward price to earnings multiple. We priced in a lot. All right. So mentioned we can look at technicals. Is this real? Is this 4-day rally just going to fizzle out? We'll look at some technicals, and the things that we do want to see are, look, we need leadership. We need new leadership, in fact. New leadership would be growth, right? That's been lagging. It's taken the biggest hit here in 2022. Think about FanMag. Think about information technology, consumer discretionary. Think about the cyclicals. All of this has been hit in favor of value. Value is what's been working. When I say working, I say that, rather loosely, because most of the market has been down year to date. Just value has taken a lesser hit than growth. So value has been outperforming growth. But here's what we've been seeing lately. Now, this is a chart of the mid-cap growth. Mid-cap growth. This is from Tom Bowley once again here. We're looking at mid-cap growth in an absolute, it looks like a downtrend, right? This just looks awful. Mid-cap growth has been downtrending basically since the start of the year. But here's the relative performance ratio of mid-cap growth to the S&P 500. And all of a sudden, basically in mid-May, we started outperforming. Mid-cap growth started outperforming the S&P 500. So underneath the surface, like I said, you want to see leadership. And if we're going to get market leadership, it's got to come from growth. It's the biggest part of the market. Information technology, the most heavily weighted sector of the market. That's growth. That's where the majority of earnings are coming from. Defensive areas of the market can't lead us out of a bear market. They're too small. So we need growth. And underneath the surface, this relative performance ratio is showing growth is outperforming the S&P 500. There's another pretty good way. And I just, in doing all of my, charts and breadth analysis and relative performance ratios that I do on a daily basis, I wanted to see, after I saw this growth ratio, I said to myself, let me go check out what FANG Plus is doing. This is the NYSE FANG Plus index relative to, well, heck, let's look at the most defensive area of the market, utilities. Let's see if that's showing anything underneath the surface of any of the indexes. And indeed, NYSE FANG Plus. So that, of course, includes Microsoft, Tesla, and of course, all your FANG stocks. And look, since late May, kind of the same thing, right? NYSE FANG or FANG Plus is outperforming, trend lines going higher, it's outperforming utilities. On an absolute basis, utilities have been performing well, up until the last couple of trading sessions at least. I mean, the defensives really got hammered the other day. I think it was Tuesday. But in general, utilities on an absolute basis by themselves, consumer staples, healthcare, been doing fantastic. Underneath the surface, though, FANG Plus has been outperforming, trend line going up ever since June. Here's the other thing. If you look at the RSI for this relative performance ratio, the RSI bottomed way back here. It attempted, with these new lows in the relative performance ratio, past March into April, then in May, then in late May, the RSI never made a lower low. And the RSI has been trending positively since. And now it's back above 50. That's kind of like the dividing line between positive relative strength or bullish relative strength and bearish relative strength is below 50. So again, looking underneath the surface, there have been good things developing, even though the S&P 500, still hanging around 3,700 coming into this week. Now we're over 3,800 in the S&P. Technically, the goal here today, for those of you who are watching price action yesterday, was for the S&P 500 to get above its 20-day moving average, which came in at 38.48. We got above that level twice yesterday, got pushed back each time. I mean, wouldn't you know it that we sold off into the close, still finished positive on the day yesterday, but did not close above the 20-day moving average. As of right now, we are nicely above the 20-day moving average. From there, it looks like we will close. We will achieve that bullish feet of strength. It's on to the 50-day moving average. And again, keep an eye on these performance ratios. You need leadership. We need the bigger parts of the market, to be revived. We need them performing on an absolute and a relative basis. So we'll see if that continues. What was lacking up until today also, folks, and I had mentioned this in a tweet, it was great that we had a 3-day rally coming into today, but man, breath was awful. When we looked at new highs versus new lows, when you looked at advancing volume and declining volume, when you just looked at the advanced decline line for the NYSE, it was down. 3 days up in the NYSE advanced decline line is down. There's more declining volume than advancing volume. Why? We didn't have small caps participating. Equal weight was lagging. Look at small caps today, folks. Oh yeah, they are participating. They're playing catch up now. What does that do? It helps broaden breadth out. It gives you a more durable advance in the market. Makes it more sturdy. It lends itself well to a continuation of the rally. We look at advanced decline line today. Wow. Now that you have small caps joining the party, more than likely you got mid caps working well. Look at this. I mean, we're 4-to-1 almost here in favor of advancing stocks. Nasdaq, more than 3-to-1 in favor of advancing stocks. Look at the volume. This is like almost 90% up volume day, possibly. We needed for small caps to participate, so now we broaden out the rally, make it more durable, sturdy, and it lends itself more favorably to continuation, possibly into tomorrow. What do we have tomorrow? Well, we've got the non-farm payroll report. We'll see what that has to say. Macro fundamentals, right? All right, moving on. Nasdaq, high-low ratio, right? This is another breadth indicator. And this one got washed out here. When we get to these levels, and this is from the sentiment trader, Jay Capil, love the guy, has great tweets. Follow him on Twitter, folks. But when this signal fires, historically, 1 week later, 100%, folks. Sample size is small. 1, 2, 3, 4, 5, 6, 7. It's small. So this is the 8th occurrence that we've signaled here, getting below 0.2. This is the 8th time. It qualifies, right? Our sample size minimum is 6. So it does qualify. So a week later, we'll see, right? That takes us into earnings season. It takes us into the banks. JP Morgan reporting next week on, I think, Thursday, the 14th, whatever day that, 7 days from now, 14th. See, math, I'm good at math, right? But the day before that, also keep in mind, folks, mark this on your calendars, the Consumer Price Index, Wednesday next week, 8:30. 100% of the time, the Nasdaq has been up a week later after this signal fires. We'll see where we close today. Mark that on your calendar as well. All right. Heard a lot about copper, right? All the metals, especially industrial metals, have been in decline. All commodities have just, fallen off a cliff here in the month of June, even into the first few trading days here in July. I mean, we had crude oil below $97 a barrel yesterday on Wednesday. We've seen wheat go from $1,200 to below $800 as of, I think, Tuesday. Now, all commodities are getting a big, kind of reflex rally here today. The one thing I do want to emphasize when it comes to, and I want to segment these out. Let's talk about crude, right? Because we need crude to, well, I mean, we'd love for it to roll over and die. I just don't see the fundamentals, right? When we talk about supply and demand side dynamics, I don't see the fundamentals supporting a rollover in crude. This has been a substantial, give back. Granted, down more than 10% in like 5-6 trading days for crude oil, going from, well, at the peak in June, 123 to 97. I mean, that's more than 10%, but just in the last few trading days, down 10%. And that's what happens. When something goes parabolic, there's no support levels when it starts to consolidate. So you get these big moves to the downside where there's no support until buyers step in and say, it's cheap enough again, given the macro fundamentals, given the supply demand dynamics at play. So when it comes to crude, don't be surprised. Don't be surprised if we're averaging, right around $100 a barrel for much of the Q3 period, and then we'll revisit this, come Q4. Because the fact is we are very supply restrained around the world for crude stock. So we shouldn't expect it to just roll over. But we think it's peaked. $123, $130 right after the invasion. We think that was the peak, but we'll probably be range bound. And as long as we are range bound, it's not going to prove very impactful for CPI. It's not going to be a positive inflection in CPI. Remember, Consumer Price Index, CPI, does not measure, prices going up or prices going down. It measures the rate of change. If we're just range bound, it's going to be neutral in the CPI. So keep that in mind. Nonetheless, going back to, we've heard a lot about Dr. Copper, and because copper's fallen down, that must mean something terrible for the economy. Dr. Copper's supposed to be a tell on the economy. Folks, there are a lot of things that get thrown about for years and years, decades and decades, that have either no practical purpose, from an investor standpoint. They really just don't mean anything to the average investor, or they're just flat out false. They're just false, right? One of them related to metals, gold. Gold's an inflation hedge. How's that working out for you? Less than $1,800 a troy ounce when we're experiencing the highest rate of inflation in 42 years. How's that working out for you as a hedge? Because it's not, never was. It never was. Just like copper's not a tell on the economy, and it never has been. Look at GDP. This is a chart of GDP over time, going all the way back to 1990. Look at copper in the bottom chart, going all the way back to 1990. Did nothing for years and years and years. Yeah, got some price action going on here. Look at this uptrend here from 2009, until we got to the COVID. And look at here, 2011, all the way to 2017, down. Did the economy go down from 2011 to 2017? No. But copper did. Imagine if you got out of the market from 2011 to 2017 because of Dr. Copper and that PhD it has. Something tells me nobody cares about the PhD of copper. It's whatever that doctorate is in, it sure is in economics. So let's keep that in mind, folks. Charts don't lie. All right, we've talked about consumer spending, retail sales, macro fundamentals. We gotta, keep our touch points, be apprised of the data week in and week out, what's going on there, mainly so we can assuage and dismiss the recessionary calls. But here's the year-over-year changes in consumer real spending on goods just fell off a cliff, kind of to be anticipated as more spending on services, right? This is real spending on goods less than services. And of course, when you get a move like this in goods, you're not going to need as much manufacturing and production going on, right? We know that. Looking at a similar chart, this was done by Game of Trade. I borrowed it, did my own mock-up. And what we can see is when you get this kind of real spending goods decline, right? I mean, we've just dropped off a cliff here in goods spending. Usually it corresponds with a spike in jobless claims. But that's not what's happening here, right? Jobless claims are still hovering around the same level for about the last 6 weeks, 220 to 230 in initial jobless claims, not going anywhere. So, in speaking to a recession, if it's going to be a recession, a technical recession, it'll be like one we've never seen before. This will be another first. This will be the first time we will have a drop-off in goods spending with no commensurate initial jobless claims spike of consequence. I mean, this is what happens in recessions. Shaded lines are recessions. Even here, mini. Here, shaded line, recession. Shaded. I mean, these are your recessions. This will be the first one that it doesn't happen. These are unprecedented times. So again, retail sales, they're not going to be out for another few weeks, but we get the high frequency data. And look how steady it is. Look how steady it is. 12s, 11s, we're paying our bill, our credit card bill, bumps up again, paying our credit bill, bumps up again, pay that credit card bill. This is actually the highest level in Red Book retail sales, which comes out every week, and it shows the year-over-year growth in retail sales, highest level since the second week of May. For everything that we've seen, prices at the pump, high, travel fare, airfares, all of this inflationary impact, the consumer's still doing well. Retail sales don't lie. The main reason why we had a decline on a month-over-month basis in the Census Bureau's monthly retail sales is because of the high comps associated back here in April. So it artificially created this, high comp. We got our tax returns and we went out and spent them, and then things have normalized ever since. But May's negative month-over-month comp was mainly because of April's outsized gain in retail sales. Now that things have normalized, I would anticipate a recovery in the Census Bureau's month-over-month retail sales. And we'll see what the revisions look like as well when they come out. The consumer remains strong, folks. In fact, we got the latest credit card or card spending data from Bank of America out this morning, July 7th. Bank of America aggregated credit and debit card spending was up 11% year over year in June. That's an acceleration, folks, from the prior month of May. That's an acceleration. And again, this is what I was talking about earlier. Trade and inventories did the damage in Q1 and Q2 GDP. Contributions to Q1 GDP are shaded light and dark is Q2. Bear with my color blindness, folks. But you can see consumer spending fine. Total fixed investment fine. It's a little less here in Q2 and actually contributing negative. But look at inventories in Q1 and Q2. Look at net trade, the trade imbalance. It's a little more favorable. We actually just got trade deficit data out today, which we were tracking. The Atlanta Fed had been tracking Q2 GDP at negative 2.1%, but we had a little bit better trade data come out for the month of June, and it was revised to negative 1.9% tracking GDP for the Q2 period. The biggest problem here has been net trade and inventories, not consumer spending, not total fixed investment. Government spending's been light, in the Q1 period, neutral in Q2, or I don't actually think the data comes out until the end of quarter for the government spending. What else doesn't happen when we have or what else happens when we are in a recession? Well, you sure as heck aren't buying, heavy duty trucks, but the latest data on U.S. heavy truck sales, and this is from Bill McBride, Calculated Risk blog. We've discussed how unique the current economic conditions are and how many firsts there would be found if indeed a recession is labeled in 2022 by the NBER. Heavy truck sales were at 475,000 in the month of June, which is down from 491,000 in May, and down only slightly, right? 476,000 in the year ago period. We were off by 1,000. Does that sound like a recession, folks? On a year-over-year basis, we were off 1,000 in heavy truck sales for the month of June on a year-over-year basis. All right. This would be a first recession when you had, heavy truck sales this solid. Also, something we talked about in our weekly research report is the fact that the real Fed funds rate is still deeply negative. What is the real Fed fund rate? It's the Fed fund rate minus the consumer price index, and it's still deeply negative. Every recession in the last 50 years was preceded by a positive real Fed funds rate. So again, this would be the first recession that we would have a negative real Fed funds rate. I kicked off atop this weekly State of the Market as I adjust myself here, with talking about leading economic indicator and the coincident economic indicators. And so you have the two plotted here in the chart from Yardeni Research or Yardeni.com. And it shows, in the yellow, we have the leading, that looks like it starts on top. And the coincident, remember, the coincident economic indicators are the one that the NBER uses to label a recession. And they just peaked in May. We won't get the June data until this month, a couple more weeks, but there's still the average recession has found the leading economic indicator. So this top one here is the LEI, which is down now 3 months in a row and 4 out of the last 5 months, right? So something in that particular indicator has already peaked and started, to roll over. But between the LEI peaking and the CEI, the average time before you're in a recession is 12 months. It could be as little as 2 months, as it was here, this recession. It could be as much as 22 months. But the average has been 12. So keep that in mind. What the media is going to tell you, whatever, it takes to get your attention. And that's kind of what this graphic highlights. This is my weekly friendly reminder that the financials and the social media, they're not your friend, but they're not your enemy, but know what they're in the business of selling, which is ad space on their platforms. There will usually prove an unbalanced approach to reporting news and are offering analysis on the markets and the economy. This graphic tells it all, folks. What's going to prove exciting versus accurate? And more often than not, they go with what's going to prove exciting. What has the media told us throughout this entire inflationary period, right? Haven't you heard that the lower wage earners, the lower income brackets have been hurt more egregiously by inflation? They're the ones that are struggling. If that's the case, then why in the heck did Moody's Analytics find that the lower 20% earners have not even tapped in the Q1 period, which is when the study was done? They didn't even tap into their savings. That's what this report from the Wall Street Journal reported on. Here is the 0 to 20% wage earners. But, based on this graphic here, Q1 2022, they have not tapped into their savings. This shade does not show up here. But they're the ones that have been hit the most, right? They're the ones that are crying out for relief, right? And yet they're not tapping into their savings. Media is telling us something very different throughout this whole inflationary period, but what are you going to do? All right, the duration of a trough to peak change in the annual inflation rate is roughly 2 years. Like when we have these inflation regimes, they usually last 2 years. Well, guess when that 2-year anniversary would have occurred, right? It started, this inflationary period started in June 20. Well, 2 years later, May 2022. And what happened in the month of June? Like all commodities just, they sold off hard. We had soft commodities, which are your agricultural goods, drop 20 and 30+%. Metals were down big. Energy was down big. RBOB, or gasoline futures, were down more than $1 in the last week and a half. 2 years. We're on schedule. Almost scary, almost eerily on schedule here, right? So how can we measure what the forward-looking expectations are for inflation. You can make the argument the market has already, recognized that inflation was going to roll over. Like, why the heck are you buying FanMag? Why are you buying growth, right? Why are you buying growth stocks if you think yields are going to continue going higher? Rates are going to continue going higher. Commodity prices just going to continue going higher, right? Growth stocks, information technology are your long duration assets that usually get hit the hardest in these types of environments. Yet what has been outperforming over the last week and a half, as we've seen commodity prices fall over. I'm sorry, more than a week and a half, my apologies. I mean, this goes back to May. The outperformance from FanMag stocks or Fang Plus stocks. They've known this. They see what's going on here in the 5-year break evens. This chart right here, 5-year break evens in the CPI. CPI is on the bottom and 5-year break evens are on the top. And the 5-year break evens typically lead the consumer price index. Look what happened to the 5-year break evens, just rolled over hard. 10-year break evens have rolled over hard as well. The market knew. The market knew that all commodities were going to roll over. And that's why you've seen long duration stocks, growth, information tech, semiconductors are now moving higher. That's why you've seen them outperform. Here we are, more updated as of July 5th. Corn, wheat, it did break through 800 here. Soybeans, chart from Charlie Bolello that we showed before. But our biggest concern, honestly, and I know energy has a huge input on CPI, but so does rent. Owner's equivalent rent is like 30% of the CPI. We've talked about that before. We saw some promising signs, and we see that has continued in the month of June. The national rent growth, this is from Zumper's National Index, and you can grab the link here. They update it every single month, so you don't have to guess. Has owner's equivalent rent. 30% of the consumer price index. Is this going to inflect positively or negatively in the CPI? Now, the data shows that Zumper's National Index is up 0.5% for 1-bedrooms, and that's what this chart identifies. 1-bedrooms, and down a whopping 2.9% for 2-bedroom apartments. So as a whole, it looks like rents have rolled over further in the month of June. We'll see what it actually looks like when the CPI comes out next week on Wednesday, the 13th. But based on everything that we've seen through the month of June, the headline number should look better. The year over year should look a lot better. CPI year over year should look a lot better. In general, we need a trend. Like, the Fed's not going to stop raising rates just because we had one good monthly print that showed improvement. They want to see a trend. They want to see a trend of disinflation setting in. Go 75 basis. Trust me, investors, you want them to go 75. You do. I know it hasn't been kind to the market. These kind of rate hike regimes, it's better to get this out of the way now, sooner rather than later. Would you rather, get shot or stabbed 100 times? That's kind of, the analogy here. Would you rather the Fed hike, 25 basis points every cycle and throughout all of 2023? Do you really want to go through that? Or let's pull forward these rate hikes, arrest inflation, get this out of the way so we can move on, focus on something else. How about improving America? I mean, I'm getting kind of tired of all these CNN and Fox Business, headlines, MSNBC, ABC, NBC, Fox News. I'm tired of seeing all these shootings. Let's move on to something that we can really benefit from, as opposed to, dealing with inflation. All right, talked about this so many times. I feel like, until I'm blue in the face, because I get the questions all the time. I think I'll just go to cash and, come back when the market's down 10%, and then I'll start to, level back in. How do you know the market's going down another 10%? You don't. I don't. I don't know if it is or if it's not. What I do know is that if I stay with the market, $100 is worth, this was a study done by Dollars and Data, and it shows you, basically identifies why you should stick with the market. We have enough information to know that even though most investors have taken on pain here in 2022, we have reasonable amount of data, quantitative studies that show us what happens after we go into a bear market, the durations of a bear market, how long a bear market lasts, on average 7, 10, 12 months. But we also know the returns 1 year later are substantial, on average 43%. Going back, the last, I think, 8 bear markets, 43%. We don't know where the exact bottom is, but what we do know is that if we layer into these, then we can actually reduce the time it takes for us to get our portfolios back to even faster than even the S&P 500. Stick with the market, folks. Does look like we are starting to see some good things materialize when it comes to the inflation situation. We want to see it trend. Also keep in mind, CPI does not measure up, down, it measures rate of change. Don't count on sub $100 oil without any improvements to the supply side. But also don't count on $130+ oil. Because I think a lot of that initial move was predicated on fear and speculation. We would tend to see and believe that crude oil be in the $100 range, but more often than not will inflect negatively in the CPI. With that being said, let's check in on this week's rally. And we have moved a little bit higher since we started our weekly state of the market. All right, everybody enjoy your weekend. We'll be back next week. Happy trading.